Money often seems to gain value or generate benefits when it moves quickly, but this emphasis on movement can also mean that money sitting still risks losing potential opportunities or growth. It is surprising that money's usefulness depends more on circulation than accumulation, because holding assets appears safer and more stable. However, the economic system is designed to encourage spending and lending rather than stagnation. The core reason is that money functions primarily as a medium of exchange, so its value depends on how often it changes hands. When money circulates, it facilitates trade and economic activity, which creates incentives for movement rather than stillness. For example, businesses prefer customers who spend regularly because each transaction supports revenue and growth. If money remains idle in savings, it does not generate flow or support these exchanges, which can slow down economic momentum. Lenders also contribute to this dynamic because when they issue loans, they create new deposits, effectively moving money into circulation. This process rewards activity by expanding the money supply tied to productive uses rather than hoarded capital. There is a hidden trade-off here. While saving provides security for individuals, excessive stillness can reduce overall economic liquidity. This tension shapes policies and behaviors that favor spending and investment over simply holding cash. Interest rates illustrate this mechanism by providing a cost or benefit linked to money's movement. When rates are low, the incentive to hold money diminishes, encouraging spending or investment to keep the economy active. Conversely, high interest rates reward saving by compensating for the opportunity cost of not spending, but they also risk slowing circulation, demonstrating the balance between encouraging flow and honoring stillness. Money's velocity, or the speed with which it changes hands, directly impacts economic growth and stability. Fast-moving money supports current economic activity and government revenues, whereas slow-moving money signals caution or uncertainty. An everyday example is how wages earned by workers typically get spent quickly on goods and services, keeping money flowing. This continuous movement supports businesses and payrolls, underlining why systems prize circulation. When money stays still, such as in long-term savings accounts, it temporarily removes purchasing power from the economy's active circulation. This can constrain others' ability to buy or invest, creating ripple effects across markets. Yet stillness is not inherently negative. It provides a foundation for risk management and future spending. The system balances these trade-offs by rewarding movement without dismissing the importance of reserve funds. This dynamic shapes consumer and business incentives. People are encouraged to spend or invest money promptly to generate returns, while also maintaining some reserves for stability. It's a continual balancing act influenced by broader economic conditions. Hidden in this mechanism is a misconception that money's value is static regardless of use. In reality, money's purchasing power and benefits fluctuate based on how actively it circulates and interacts with the economy. Financial institutions further promote movement by charging fees or providing rewards linked to transaction frequency, creating incentives for continual use rather than inactivity. This operational design supports the broader economic logic. Moreover, governments collect taxes largely from economic activities tied to money's movement, such as sales or income, which means active circulation also supports public services. This feedback loop reinforces the system's preference for flow. Some might assume that simply accumulating money ensures growth, but without circulation, those funds have limited impact. The system's structure ensures that money needs to be part of exchanges to contribute to broader prosperity. The trade-off between liquidity and security explains why economic policies often encourage borrowing and spending during downturns, seeing movement as a way to revive slowed activity. This illustrates the incentive to prioritize flow in tough times. At the same time, excessive movement without adequate saving can lead to instability, showing that stillness also has a role in maintaining long-term health. This creates a nuanced balance shaping how money functions in different contexts. Understanding why money rewards movement over stillness clarifies many financial phenomena, from inflation to credit cycles. It highlights how money's design aligns incentives around activity rather than passivity. This perspective shifts the view of money from a static store of value to a dynamic tool fueling exchange and economic coordination. Recognizing this function helps explain why economic systems emphasize flow. In summary, money's value and effectiveness depend heavily on movement because it enables trade, supports incomes, and generates public revenue. Stillness plays an important but more limited role focused on stability. The resulting balance between flow and stillness reflects underlying incentives and constraints built into monetary systems. This balance shapes how individuals, businesses, and institutions interact with money daily. Ultimately, understanding this mechanism reveals why economic health relies on money circulation as much as on its accumulation, providing clarity on a fundamental feature of modern financial systems.